What if the business you're about to buy is hiding $200,000 from you? That's not a hypothetical. It happened to one of our clients, and a quality of earnings report caught it before they signed. In the next 8 minutes, you'll understand exactly what a QOE is, how it works, and why skipping it could be the most expensive mistake you ever make. Here's what we're going to cover. First, what a quality of earnings report actually is and why it exists. Second, the core problem with trusting a seller's numbers. Third, what normalized EBITDA means and how it's calculated. And fourth, a real case study, a landscaping business acquisition, where our QOE uncovered over $200,000 in misrepresented earnings. So, what is a quality of earnings report? Simply put, it's an independent financial analysis of a business you're considering buying. The seller gives you their numbers, their tax returns, their profit and loss statements, their add-backs. A QOE report takes those same numbers and subjects them to rigorous scrutiny. The goal is to answer one critical question. Do these earnings actually reflect the true, ongoing earning power of this business? Seller numbers tell one story. A QOE report tells you the truth. Here's the core problem when buying a small business. Sellers present their financials in the most favorable light possible. That's human nature. They add back personal expenses. They include one-time revenue as if it were recurring. And they defer maintenance costs to keep margins looking healthy. What you see on the surface and what's actually happening inside the business can be dramatically different. A QOE report sits in the middle. It examines what the seller shows, questions every line item, and delivers what the buyer actually needs to know before making a multi-million-dollar decision. Let's talk about normalized EBITDA, because this is the number that drives your purchase price. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Normalized EBITDA takes that figure and adjusts it to reflect the true, sustainable earnings of the business. That means adding back legitimate owner-specific expenses that won't carry over to you as the new owner, and removing one-time items, non-recurring revenue, and any earnings that are artificially inflated. The goal is a clean, honest number you can actually underwrite. Now let's walk through a real case. A buyer came to OGS Capital while under LOI on a landscaping business. The seller was claiming strong EBITDA and had priced the business accordingly. On the surface, the deal looked attractive. But something didn't add up. We conducted a full quality of earnings review, and what we found changed everything. The financials had been presented in a way that masked over $200,000 in issues that would have landed squarely on the buyer's plate the moment they signed. Finding number 1. Overstated owner add-backs totaling $85,000. The seller had added back expenses to EBITDA that weren't legitimate. This included personal vehicle expenses claimed as business costs, inflated compensation to family members, and personal travel run through the company. When we normalized these items, $85,000 came right off the top of the earnings the buyer was about to pay a multiple on. That's a significant reduction in business value, and it almost went undetected. Finding number 2. Non-recurring revenue of $60,000. The seller had included a large one-time contract in the trailing 12 months of revenue, a contract that had already ended and would not be renewed. This revenue was being presented as part of the ongoing business without disclosure. Our QOE identified it, flagged it as non-recurring, and removed it from normalized earnings. Buyers pay multiples on recurring revenue. One-time revenue shouldn't factor into your valuation, but it will if no one's watching. Finding number 3. Deferred maintenance costs of $55,000. The seller had been skipping routine equipment maintenance for years, artificially keeping operating expenses low and margins looking better than they were. For the buyer, this meant inheriting a fleet of equipment that needed immediate attention. Those costs weren't on the P&L. They weren't visible in any financials the seller provided, but they were real, and they were coming. Our QOE surfaced them before the deal closed. Here's what the restated financials looked like after our quality of earnings adjustments. Before QOE, the seller's EBITDA supported a purchase price that reflected inflated earnings. After QOE, the normalized EBITDA was materially lower, which meant the business was worth significantly less than the asking price. The buyer was able to renegotiate the deal, close at a fair price, and avoid absorbing over $200,000 in hidden liabilities. The QOE cost a fraction of what it saved. Those three findings aren't unusual. They're representative of the four most common things sellers hide that a quality of earnings report uncovers every time. Overstated add-backs, non-recurring revenue buried in the numbers, deferred maintenance and hidden liabilities, and related party transactions that distort true profitability. These four issues appear in the vast majority of small business acquisitions. A QOE doesn't just find them, it quantifies them, so you can negotiate from a position of knowledge instead of assumption. You might be wondering, isn't this what an audit does? No, and the distinction matters. An audit looks backward to verify that financial statements comply with accounting standards. It's focused on accuracy for reporting purposes. It's expensive, it takes months, and it's designed for lenders and regulators. A quality of earnings report is designed for you, the buyer. It looks at whether the business's earnings are real, sustainable, and accurately represented. It's faster, more focused, and specifically built to support acquisition decisions. So when do you actually need a QOE report? Here's a simple framework. If you're acquiring a business for over $1 million, a QOE is strongly recommended. The cost is minimal relative to the transaction size and the risk. If you're using an SBA loan, many lenders now require one, and for good reason. If the seller's financials are complex, involve significant add-backs, or if something just doesn't feel right, get a QOE. The question isn't whether you can afford one, it's whether you can afford to close without one. If you're in the process of buying a business and you want to make sure you're not overpaying or worse, inheriting someone else's problems, we'd like to talk. OGS Capital offers a free 15-minute consultation to walk through your deal and help you understand whether a quality of earnings report makes sense for your situation. The link is in the description. If you have questions, drop them in the comments. We read everything. Don't sign until you know what you're actually buying.